unit trusts.
What is the market outlook for small and mid caps in Asia in the next few years?
We invest in the small mid cap space utilizing a bottom-up approach. So we're not trying to forecast what the overall market will do. That said, we do believe that the small mid cap space in Asia is ideal for active fund management, especially for fundamentally driven bottom-up stock pickers. And we hold this view because there's a great deal of information asymmetry in the small cap space. Relative to large caps, information is disseminated far less efficiently in the small cap space. And this is really a function of a lack of quality sell-side coverage in the small cap space. To provide context, in the MSCI Asia Japan index, the typical company is covered by more than 20 analysts. For the small cap index, that number is 5. And there are hundreds of companies that have zero sell-side coverage at all. And this is the opportunity. This is why we firmly believe that proper fundamental analysis in the small cap space can deliver highly attractive risk-reward opportunities.
Okay, have there been any particular sectors which have outperformed or underperformed? What's the outlook for the various sectors' earnings for the next few years?
Looking back over the past few years, companies in Southeast Asia that benefit from domestic demand, in particular in the healthcare and consumer sectors, they've done very well. They have experienced a considerable re-rating and valuation, and their share prices have performed very well. And this is very much reflected in the prevailing valuations for these stocks. At this point in time, many of these stocks are probably at risk of actual derating if they're unable to ultimately deliver the earnings growth that is being priced into these stocks. At the moment, Chinese equities, both large cap and small cap, are surging. And we see this really as a function of low valuations and a significant improvement in liquidity, rather than an improvement in the overall fundamental outlook for Chinese equities.
Next question. Is it difficult to find companies to invest in? What are the key criteria for your selection?
Our key criteria can be summarized by the following: quality business, good management and corporate governance, and attractive valuations. Now, finding companies that are high quality with good management teams is not difficult. What is much more challenging is to find these types of companies trading at attractive valuations. And the reason is that everyone wants to own these companies. And as a result, they tend to be very expensive. Ideally, we're looking to invest in companies that can compound earnings and cash flows through a business cycle and offer the scope for valuation re-rating. Now, that's difficult. That's hard to find. And in order to identify those opportunities, we intentionally seek out lesser-known companies and those businesses that are currently out of market favor. Traits that we look for in companies and potential holdings include strong balance sheets, good cash flow generation, and high returns on capital. And central to our investment process is when analyzing a company, we really endeavor to truly understand that company's business model and its real economic reality. And just as importantly, we really try to understand what the underlying motivation of the controlling shareholder and the management team is. So we ask ourselves questions such as, can this business endure evolving competitive forces and protect or even improve its margins through a business cycle? And what is the overall level of corporate governance? Are there red flags? Are the interests of minority shareholders ultimately aligned with those of the controlling shareholder? These are critical questions, and once we have a handle on this, valuing that business is fairly straightforward.
Last question. How does Deutsche invest in Asian small and medium cap differently from their peers?
There are 2 points I would highlight. One is that we truly benefit by being part of a global multi-asset platform. So we have colleagues who are investment professionals spanning asset classes and offices around the world. And just one small example of how we here in Singapore benefit from that can be seen in our own office. Our equity team sits right next to the fixed income team. And it turns out there are actually many times where there's an overlap in terms of the companies that we're looking at. And these opportunities provide us the chance to interact with our credit analyst and to gain their perspective. And oftentimes the credit analysts provide a very different perspective, a very different contribution to the analysis. And over the years, we have found this collaboration to be invaluable. The second point I would highlight is that because of my background in forensic accounting, I am acutely aware of how easily financial statements can be manipulated to distort economic reality. We'll see companies with a great P&L, great earnings, but the cash flows are not there to really support those earnings. So with this in mind, we spend a considerable amount of time rigorously analyzing financial statements and effectively restate the financials. And the goal in conducting this exercise is one, to determine what we believe are the true cash flows being generated by that business, and then two, to reconcile those cash flows to determine where that cash is allocated, how much is being spent on dividends, CapEx, M&A activity, retiring debt. And once you do this kind of analysis, you have a very clear picture of the business's true economic reality. And as a result, we're very easily able to identify the high quality businesses from those that are of average or low quality.